Hello, everybody. Today is Saturday of Memorial Day weekend of the year 2022. And this video is entitled Where Greed and Fear Meet. We are seeing a unusually bad beginning to an investment year this year. And we just recently came off 8 losing weeks in a row. Setting a record that dates back to 1932. But this last week was a bump up. And we've seen the NASDAQ go up 7% just in the last 5 business days. The S&P 500 up 6%, and the Dow up 5%. The FANG stocks, known as Facebook, Amazon, Apple, Netflix, and Google, for the week we're up, but only up 4.4%. The FANG stocks, I bring those up because they have been kind of the stock market darling favorites, the top of the S&P 500 allocation and the NASDAQ allocation now for the last several years. Now, year to date, we have a 23% decline in the NASDAQ. So that was 30% before the uptick here this last week. We got the S&P 500 down 13% currently. It was down briefly 20%. And we had the Dow down 9%. It was down as much as 14% going into this last week. And Facebook stocks, the FANG stocks, are down now year to date 36%. They were down 40 to 41% going into last week. And I would say that if you went back to a New Year's Eve party and you told people that were heavily invested in these FANG stocks that in 5 short months they might be down over 40%, they would have laughed you out of the room. But so it has happened. And this is what happens when greed and fear meet, is that growth stocks that are arguably very overvalued, don't pay hardly any money in dividends, don't have much in the way of underlying assets, but have this great story, but if the story changes, the price can fall quite dramatically. So, we have seen now where greed and fear have met, and so far it doesn't look so good. So the question, becomes, how's the rest of the year play out? So just looking at each of these FANG stocks, Apple is down 18%. Netflix is down a whopping 67%. Amazon 32%. Facebook 42%, and Google 23%. Those are some pretty substantial declines, and there are people that have accumulated significant amounts of capital gains in those investments. And currently, when I see what the sentiment of investors is on these, people don't seem to be completely of the mindset that things might actually get meaningfully worse as compared to getting better. Just as a note, the NASDAQ 100, the QQQ, the big growth names of the dot-com bubble bust, from the spring of 2000 until the fall of 2002, those stocks would decline 80%. So where we stand today relative to what could happen, it may just be kind of the beginning of things. Now let's think about what is working this year. The best performing stocks or categories of investing year to date the S&P Goldman Sachs Commodities Index. That is up 48% this year. The Dow Jones Global Oil and Gas Index is up 32%. Latin America is up 21%. U.S. Telecom is up 8%, and U.S. utilities are up 5.9%, and that's it. Those are the categories of investing that have positive gains for this year. The losers, the real bad places, the worst performing index that I can find is the NASDAQ 100. It is down 24% currently. Mid-cap growth, Russell 1000 growth, the JP Morgan Emerging Market Bond Index, the Russell 2000 is down 15%. Emerging market stocks are down 15%. Japan is down 14%. Basically, what you're seeing here is risk assets that are being dramatically downward priced. The safer haven has been value stocks. So where do we stand now? So my accounts after this last week have recaptured some minor losses that it had, and my average client right now is at a break even for the year. I have also recently made some moves here in the last week or so to sell off some assets and generate some more cash. I've been looking at the ratios of stocks versus bonds and cash and wanted to increase those levels a little bit. So being at a break-even year to date was good luck, hard work, good instinct, and a focus on value-oriented investing. The areas that have done well, my clients have participation right now in the commodity stocks, energy, global telecom, among other things. And so that has kept the red ink from showing up on your statements. So what's my outlook from here? Right now, I believe there's just simply too many headwinds to expect that we are currently at a bottom in the market where this last week is indicative of some sort of a turnaround. Portfolios now, my clients are very value-oriented portfolios with a strong bias towards energy and commodities. The bond and cash side of client portfolios right now is extremely conservative. It is of the highest quality, U.S. government, and it's very short duration. The average duration on the bond portfolio for clients is basically a year or less. So there's basically no exposure to interest rate risk going forward. So here's an update on some of the headwinds of the financial markets that I see, and an indication. I use these headwinds and where we are with them hopefully as a tool to identify once we've gotten deep enough in a downturn where potentially there's an opportunity to be buying without getting in too early. So the Fed rate hikes. So if we use a baseball analogy of the first inning of the baseball game being the beginning and the ninth inning being the end of the game, I would say that from an interest rate standpoint, we are probably in the middle of the game. We're at the fifth inning. Consumer sentiment, how do I personally view what the public is thinking and doing right now? Are they still greedy? Are they fearful? How do they feel about the security of their jobs and things like that? I still find the consumer sentiment to be surprisingly positive and bullish despite what's going on in the economy today. This, by the way, is not unusual. In past severe market events, the consumer is actually a lagging indicator of where we are. The consumer sometimes cannot understand why the market's going down when they see things so positively. Conversely, at the bottom of a market, or when things have turned around and the stocks are going higher and higher, but they're unemployed and they're miserable, they can't understand why the stock market is doing well when they're so miserable. So the consumer is an important guide for where we are. And right now, they are still, not really concerned about what's going on in the economy today, and I feel that they should be. Hopefully, these people have made, preparations to have money saved up for the rainy day that's probably coming. I follow cryptocurrency. It's not that I'm necessarily a believer in it, but it is an asset that is indicative of our society today. Some people believe that it's a Ponzi scheme and a ruse, and it has no value. Other people think it's the future of investing. Personally, I believe that the Fed wants to burst that bubble a bit, and I would say that maybe they're halfway done. I think we might be in the fifth inning of that ball game. We've seen meaningful price erosion in some of the lesser known names, and some of the bigger names like Ethereum and Bitcoin have had pretty meaningful corrections at this time. So I think we're about halfway there. Housing prices, we are starting to finally see signs of the bubble beginning to burst there. We saw housing inventory go from a 6-month supply to a 9-month supply in just 1 month. I believe that was some sort of a record-setting event. So that, much like consumer sentiment, it is a bit of a lagging indicator. Housing is indicative of consumer confidence. And while it's still strong, there's still some buying going on. But with interest rates as high as they've gotten, the cost of $1 million house has changed rather dramatically since the beginning of the year. So prices are going to need to reflect these higher interest rates and a slowing economy. Unemployment. We have yet to see any real meaningful uptick in unemployment. So we are in literally the first inning of that game. But I can only suspect that in the coming of the next several months that might very well change. Credit spreads, the amount of interest you are paid on a lower quality debt instrument as compared to a very high quality debt instruments, is still rather narrow. I am looking for that to go wider, so I would say that's only in the third inning in the ballgame. Gross domestic product, the GDP measurement, which is used for inflation measurement. We've already had one negative quarter, the first quarter. I personally believe that it would be very difficult in that case to have a positive GDP number for the second quarter. Could it happen? I suppose it could. But I do think that we are going to see a slowing of GDP for probably 3 or 4 quarters in a row. I wouldn't necessarily wait until the fourth negative quarter, but in the fall, that would be the third quarter. Maybe that's a time to act. So I would say we're in maybe the third inning of that game. Analyst revisions. This is where Wall Street looks at a company and decides how much money is this company going to make in a profit per share or a loss per share relative to the shares. And they will take the comments from a company and try and create some sort of a guideline as to the earnings of a company. When you go from a strong bull market into a bear market, oftentimes the analyst expectations for a company for a while remain kind of elevated until the undeniable reality kicks in and the analysts start scratching out that number and coming in with a lower number. Stock investors oftentimes get very angry and upset because they bought a stock based upon this analyst revisions, and then after the stock has fallen dramatically, the analyst lowers the guidance of profits on it and might change the rating from a buy to a hold, or from a outperform to a sell. Shareholders don't really care for that. And the analyst revisions have really yet to really start yet. So I'd call that the first or second inning of the game. Now, once they start making these revisions, if they do, the street, will have to reprice what they believe a company is worth. I mean, companies that are currently trading at 30 or 40 times their net profit, well, people might say that, hey, this company's only worth 10 or 15 times its profit. So therein lies a substantial downside move should that occur. Financial institution failures. When you go from a frothy bull market to a bear market, somebody pays the price. Well, we've already seen a substantial failure in the crypto market that cost untold billions and billions of dollars. And so we've seen some signs of this. We've seen hedge funds close. We're seeing the beginning of these kinds of things happening. Do I expect financial institution failures to the degree of 2008 and 9? I don't think so. Possible, but I don't think so. Now, what would make it worse would be if people that bought all of these super expensive and overpriced homes over the last 24 months, if they all of a sudden just start throwing the keys back at the bank, if they see losses, that could be a problem. And I, to this day, cannot figure out how this time is any different than the frothy real estate market that led to that disaster. Well, heaven help us all, or we're going to potentially go through that again. Stock indexes, how do I feel about where the Dow, the NASDAQ, and the S&P 500 are right now? I do believe that they have a fairly meaningful amount to go down from here. I would really like to see the S&P 500 down about 30%. It was down 20%, but it had a pretty good rally here, so now we're only down 13%. But we are in a very volatile market right now. By the way, this last week, a suspect area there is some people refer to a big up move in an otherwise very strong down market as a bear trap, that it kind of sucks people into it. The volume, the amount of activity going on Wall Street buying and selling stocks has actually declined last week. So stocks were up on lower volume. That's generally not a particularly confidence building scenario. Buy list. So, how do I feel about specific companies that I'm interested in? I'm starting to see stuff that, looks really, really attractive. There are some really great bargains right now. And measured in the terms of, where are we going to be 3, 4, 5, 10 years from right now? I would say that we are already at a point where some of the stocks today are priced very attractively if you look farther out. But I do believe that there's still some room to go down, and I'm going to be patient and wait for that. The volatility index, the VIX is what it's called. It's a measurement of risk, perceived risk in the market based upon calculating how options are trading within the stock market. And the VIX has become slowly more and more and more elevated, with giving the appearance that it's going towards a bigger and bigger event. And so it has been a fairly reliable indicator in the past. I do question whether the VIX is as reliable as it was in the past. But regardless, volatility probably needs to be picked up. But I give that about a 5 in the baseball game, 5th inning. Empirical evidence, that which I see with my own 2 eyes. I think back to 2008 as I drove to see a client down in Hood Canal in a fancy neighborhood with a lot of second homes, vacation homes. And as I drove down the road of the Hood Canal to see my client, there was a for sale sign in front of at least a third of the homes as I drove out to meet him. And that was kind of the empirical evidence of the bubble having burst in real estate. And it was interesting times. So the empirical evidence right now, it's barely started. The 2nd inning of the game, I would call it. Scandals. Every massive bear market has a blame game, and it has bad actors that are exposed. It generally doesn't come out until you're really deep into the trouble. And so far, we've seen a little bit of this activity going on, but not to the degree that I'm looking for. I would say it's in the 3rd inning of the ball game. Lastly, the Fed's balance sheet. So the Fed, during COVID, et cetera, after 2008-9, did a lot of bond buying. They buy bonds from the stock market and bond market, trading platform, and put it on their balance sheet. And what they do is they put cash into the economic system of the world. So they are creating cash, and cash needs to go somewhere eventually. So it does things, and it creates potentially significant economic growth. Well, some people blame the Fed for having put too much cash into the system and created inflation and a runaway, frothy bubble markets in bonds, stocks, real estate, crypto, etc. So now the Fed is going to start selling off some of these bonds into the public and institutions in hopes that they buy this stuff, and the Fed will take cash away from the system. And well, all I can say is it'll be interesting to see what appetite does the world have for these assets in light of the fact that, well, everyone knows that they're raising interest rates. So, there's potential for meaningful disruption in the mortgage-backed securities market because of this, and the bond market, because there's going to be this increasing supply of debt instruments. There's only so much appetite for it. And what if they scare off buyers? What could happen to the stability of the bond market? And this hasn't even started. So, in the first inning of the ball game, you got warm-up pitches going on right now, and this is supposed to happen relatively soon. So, what's my plan going forward? My plan going forward is that while I plan on trying to buy near the low, I'd be foolish if I'm trying to pick the bottom, because if I miss the bottom, I could miss out on the opportunity that I worked so hard to create for my clients. So if anything, I do plan on being slightly early to the party. And again, there's so much value out there in many of the things that I'm looking at that if I was to be a little early, I think given more time, a year, 2, 3, 4, 10, it's not going to be meaningful should I get in a little bit early. I do plan on having a timeline of buying. I will not simply take all the cash or investable assets at one time and do buying. I will instead be spreading it out, likely over a 60 to 100 day period, let's just say. I am working on and have identified specific areas and stocks and regions and countries and themes that I plan on investing in. That's still on my mind, and I'm looking. But I have a pretty good idea of what I want to do. And I also know the areas that I plan on avoiding. This last bull market, the chance that we go from a bull market to a very severe bear market, and then a new uprise in the market, it's generally not going to reward the same names as on the other side. But a lot of people are inclined to believe so, and I think they will be sadly mistaken. I generally see the early fall of this year, so October, November, that is, in my mind, the probable area of entry. And he says, well, that sounds fairly soon, but it's consistent with severe bear markets in the past. Bear markets don't take forever to manifest themselves. The market goes down faster than it goes up, and we're kind of seeing that now. We had 8 weeks in a row of significant declines in the U.S. equity market and global markets. So many of my scores here that I'm watching, I do plan on believing being at the end of the game or close to it by roughly October. We also have the election, which will become a bigger and bigger focus, potentially distraction to the financial markets coming up. To wrap things up, I want to thank you for being my client, or if you're watching this as somebody that is contemplating investing with me, I would welcome you aboard at this time if you meet my minimum criteria. A great opportunity awaits us, but I can assure you that there will be doubt and uncertainty going forward. I do believe I have gone as far as I possibly can to protect and defend the capital of my clients right now, and so I feel good about that. If you have referrals, if there are people that you know that might benefit from defense and a game plan going forward, I welcome your referrals. And certainly if you have any questions or concerns, give me a phone call. And until my next update, stay safe. Enjoy the nice arrival of spring weather. Take care.